He said in October 1907, Knicker Trust failed due to risky bets sparking panic. Two others failed, and it's
Putin is currently moving nukes next to Poland, in Belarus, and the China-Russia alliance, as well as the Russia war, which has no end in sight. And the most important and riskiest, I think, is the commercial real estate office loans. So let's look at the last 10 recessions the US has experienced since 1950. My analysis looks at how the S&P 500 has performed during each US recession since the mid-1950s. In 1973 through 1975 and the 1980s recessions, which is the closest to what we are experiencing right now.
Welcome to Fatty 2.0, from homeless to landlord. And remember, if you had a terrible, terrible day, at least your name is not Fatty. Anyways, let's talk about what's been happening in the economy and the stock market and what massive catastrophic risks are facing the stock market these days. And let's talk about also what Michael Burry just tweeted recently. He said in October 1907, Knicker Trust failed due to risky bets sparking panic. Two others failed and it spread. JP Morgan made a stand. 3 weeks later, panic resolved and markets bottomed. So he's implying that the markets have bottomed. I seriously doubt that the markets have bottomed. The reason why, he's not looking at the macro picture of what's happening right now. The first massive risk, I think, is the geopolitical risks, which I'm about to talk about.
So as you can see in this PowerPoint presentation, the geopolitical risks include number 1 and 2, Iran war threat that's been recently happening, as well as the Saudi Arabia and Iran alliance, which was brokered by China. This happened also recently. And number 4, 5, and 6, Putin is currently moving nukes next to Poland, in Belarus, and the China-Russia alliance, as well as the Russia war, which has no end in sight. So pretty much number 1, 2, 4, 5, and 6 have a massive impact on oil prices, and this could make oil prices shoot right back up to $130 a barrel and beyond. And this would cause an absolute destruction in the global economies. And as you can see here, number 3, China and Taiwan war invasion, which I predict is going to happen within a year. It could cause an absolute rise in overall chip manufacturing. The prices will skyrocket, as well as all the products made in China will also rise significantly because of the potential war between China and Taiwan. And of course, the US will get involved and put sanctions. So you can see this will cause a huge rise in overall inflation, as most of the products made in the world are made in China.
And the second risk, of course, are the economical risks.
As you can see here in the second PowerPoint, the economical risks include the banking system collapse, which pretty much the bank runs, I think, will continue happening. And at the same time, banks will continue tightening credit due to the fact that they have way lower deposits now, and the risk is high to lose those deposits. The second, as you can see here, is commercial real estate risk, loans that the banks have. And the most important and riskiest, I think, is the commercial real estate office loans, because of the fact, 2 reasons. The first one is there is 50% vacancy in all the office buildings, and the income, of course, is way lower for the owners of those buildings. And at the same time, there is a huge amount of loans, commercial real estate loans, are coming due for refinance this year, 2023, at way higher interest rates. The next risk is the credit card debt, which is skyrocketing. The balances are skyrocketing along with delinquencies. And the last one is the home mortgages. It's the same thing happening as people continue to get laid off. There are way more delinquencies when it comes to paying their mortgages, people paying their mortgages. And the last one is earnings recession, which is pretty easily seen as interest rates are the highest in 40 years. And at the same time, inflation is super high as well. And the last one is war risk, which we talked about, which will cause a commodity supercycle, especially in oil.
But I think the geopolitical risks way outweigh the economical, because geopolitical risks will create absolute disaster in the economies across the globe, not just the US, due to commodity supercycles we're going to experience. Once, not if, once these geopolitical risks come to fruition. So let's look at a 10,000-foot view of what's happening in the world right now. Iran and Saudi Arabia, put it simply, just became best friends. And after years and decades of fighting and hating each other, and one of them is Sunni and the other is Shiite, and these two Muslim denominations hate each other. They can't stand each other. So China just brokered the peace between Iran and Saudi Arabia. And these are world powers when it comes to oil. They control the oil supply in the world. China, Russia, Saudi Arabia, and Iran, they want to overthrow the U.S. and the U.S. dollar, call it the petrodollar. They want to overthrow it and use other currencies instead of the petrodollar. Petrodollar is basically the U.S. dollar that's used to pay for oil exploring countries. And this is their primary source of revenue for many other OPEC members and other oil exporters. So they're trying to basically hurt the US by using other currencies. That China actually used the yuan recently. So basically their whole goal, I think, is to overthrow the US as the world power.
And it's actually happening right now as I speak. BRICS, which is an acronym for 5 leading emerging economies. It's Brazil, Russia, India, China, and South Africa. They're currently working right now to create a brand new currency to overthrow the dollar.
And of course, I know everybody laughs at North Korea. They say they have, prop weapons and whatnot, but I seriously doubt this is the case, because not a lot of people know this, but China owns North Korea. They literally control 100% of North Korea. Unfortunately, North Korea is pretty much a factory, a concentration camp factory that makes nuclear weapons and weapons to China for very, very discounted rates. And China sends them all that money, and of course, North Korea, they're using their citizens as prisoners, all of them, and all they do is just make weapons. So this is how they make their income. And of course, they do hacking and all kinds of stuff, but I think their main source of income is China and making lethal nuclear weapons, and they sell them to Iran. Xi of China just visited Russia, Moscow. And it's funny, it came not even 2 days after the International Court put a warrant to, take Putin, to jail, basically, for all the war crimes he's committed. Not even a day or two, President Xi of China goes and visits Russia in, solidarity and support for Putin. So basically, when Xi was in Russia, he stated that changes, or pretty much a new world order not seen in 100 years, is coming. But China has been sending weapons to Russia for a long time, and the CIA intelligence just recently stated that China is contemplating to send weapons to Russia. But I think it's been happening for a long time. And by the way, the Russian war has no end in sight. I don't know why people are saying that is coming to an end soon. Putin is running out of weapons. They're mocking the Russian military. So let's look at what's happening in Russia and Ukraine right now. Russia's number one source of income is oil. And basically, Russia makes $1 billion a day in oil sales. The cost of war is estimated between 300 to 500 million a day. So he's using Russia as a company and the war as a company, as a business. You make $1 billion a day. It costs you $500 million a day or less for the war. What is the net profit? Multiply this times 365 days a year. You can do the math. How much money he's making. If the war stops, oil will plummet. Right now, I think last I looked, it was $72, $73 for the WTI. If the war stops tomorrow, oil will plummet to probably $30. What's going to happen to Russia? It's going to collapse. Absolutely collapse because of all the sanctions and whatnot. So it's in his best interest to keep the war going, no matter what. And he's getting support from China. He's getting support from Iran. He's getting support from Saudi Arabia under the table. They're all OPEC countries. They have special interest to keep the war going. Because if the war stops, oil plummets, they all lose money. Billions and trillions of dollars. So I just don't see the point of the war stopping. It's going to be a multi-year war, I think. So moving on. Putin just recently moved strategic nuclear weapons to Belarus, which is right next to Poland, which is an absolutely scary thing right now. He's basically blackmailing the world with nuclear weapons. And he said this is in response to Britain's decision last week to provide Ukraine with armor-piercing rounds containing depleted uranium. So he's not very happy of what's going on, and the whole world is helping Ukraine, basically. So now let's talk about the Iran war threat, which, like I said, once again, I feel like it's pretty funny that oil started dropping really hard, and all of a sudden, Iran, out of nowhere, attacks using drones a military base in Syria, and they actually killed one American contractor. And I'm just shocked that the U.S. is not going to war with Iran right now, because if you kill one American, you threaten all, right? So one American was killed on the base, another was wounded, and then 5 servicemen, military members, were also wounded. And what did the U.S. do? They just strike back Iran. That's it. We didn't go to war, which is the reason why is because if we go to war, what's going to happen to oil? Skyrocket. What's going to happen to inflation? Triple. This is going to be a disaster. So that's why Biden is not really doing anything about it. And he's not. He's not going to do anything about it. Because right now we're in a very vulnerable position inflation-wise. So another massive risk I think is coming is the China-Taiwan invasion. Every year, or every time the president of China, speaks, he basically states that Taiwan belongs to us. We are taking Taiwan back. And let me tell you, basically, like, I think it's happening sooner than later. China invades Taiwan. But let's look real quick at what could happen if China invades Taiwan. I'm sorry, not if, when. China is by far the leader in the battery race with nearly 80% global battery cell manufacturing capacity. 80%. So if you want a Tesla, 80% of the batteries come from China. 98% of microchips are utilized by the Department of Defense. They're all manufactured in China, in Asia. Which is if China goes to war and takes over Taiwan, Asia will be an absolute mess. So you can imagine what's going to happen. Also, 85% of refining capacity for rare earth minerals is controlled by China. 85%. So lithium to make batteries, everything, copper, you name it. Taiwan makes 65% of the world's semiconductors and almost 90% of advanced microchips. So if China takes over Taiwan and the war is going, what's going to happen to TVs you want to buy, or cell phones, or cars, anything? Anything will absolutely skyrocket. So this is what I meant when I said commodity supercycle. And I can guarantee you, Biden keeps saying he's going to send military to Taiwan, he's going to fight China if they do this. I am pretty much sure he's not going to do anything right now, and China knows this. They know that if he retaliates, inflation will triple, and it's going to cause an absolute deep depression in the whole world, global depression, not just the US. So he knows this, and China knows this. So my thinking is, everybody's saying Taiwan is going to be invaded 2027. I highly doubt that, because I hate to say this, but the administration in the US right now is one of the weakest we've ever had in our lifetime. So I think China will invade Taiwan within a year, because why would they risk waiting to 2024 elections and wait for a strong American president who's actually going to do something about it? The second reason is why China would strike now instead of waiting until 2027 is the combination of both, like I said, a weak administration as well as 40-year high inflation. If they wait until 2027, the US could already have a strong administration and inflation could come down significantly. So now is the time to strike, because if the US puts sanctions on China, inflation, like I said before, would double, triple. So now is the time to strike. So I think the invasion will happen way sooner than anybody thinks. The invasion of Taiwan. So, which is going to be a huge disaster for everybody. The last thing I want to talk about is every empire in the history of the world fell. The US has been the world power for over 100 years. And every empire, like I said, eventually fell. For example, Persian Empire, it fell. Han Dynasty, Russian Empire, and the British Empire. So if Russia and China, Iran and Saudi Arabia, who control products and oil, pretty much everything, get together and decide to destroy the US, especially with a weak administration right now, what do you think is going to happen? Now let's talk about the economical risks that we're facing in the US and actually the whole world. The banking system collapse. It's happening in America and it's happening overseas as well with Credit Suisse. And I think it's going to continue happening. So let's look at a quick, big picture of what's going on. The FDIC only has $250 billion in availability to help clients if something happens to their bank. The banking sector, the entire banking sector, is $2 trillion. Let's say 15% of the $2 trillion goes bust. If you do the math, the FDIC does not have enough money to cover everyone. I know they keep saying we're guaranteeing anything above 250. They can't save everyone. That's the problem, I think. That's the biggest risk. And you saw how SVB, when the collapse happened, now they're saying that $100 billion was leaving the bank within a week. It's unreal. This never happened in the history of the world, where that much money leaves so quickly in literally a couple of days, like $100 billion. But the reason why I think is Twitter, the power of social media. When someone tweets something, it goes viral. Next thing you know, there's panic. So this never happened before. So there's good things about social media and of course bad things, and this is the bad thing. Deposits in small banks fell $119 billion the second week of March. It beat the 2008 crisis. So regional banks, I think, will continue to collapse. And it started with crypto and FTX, Silvergate Bank, then, of course, SVB followed. Now, First Republic Bank is next. I saw an article stating that the sale will not go through anymore, the purchase of First Republic. But yeah, it just continues and continues, and I think it's going to get worse. So banks are I'm sure you're thinking, like, what does this have to do with stocks, like other than bank stocks? So banks are the heart of the economy. If the heart stops, what happens to the rest of the body? Banks collapse, businesses cannot borrow money, banks tighten, and the banks will tighten credit. Simply put, if banks don't lend, companies who are in a tight position because of inflation, they can't ride through pain. They have to borrow. So banks, when they tighten, those companies, any company, not specific, but any company in the US or the world, when they can't borrow money, they can't survive. And if they can't survive, they go out of business. So I think there's going to be a bunch of bankruptcies coming soon. So the biggest risk, I think, for the banking sector and the entire stock market and the economy is the commercial real estate. Based on Bank of America, there was an article out there stating that the next pain point for regional banks will be the commercial real estate loans. And they said that 68% of commercial real estate loans is lent to U.S. regional banks. That's pretty massive. That's a pretty massive amount. A combination of low occupancy and a wave of refinancing at higher interest rates could spell trouble for banks, big trouble. Based also on that article, Bank of America. And it should hit the entire stock market and the broader economy. Low occupancy, especially in office space, this is the one that's getting hit, the sector that's getting hit the most, I think. Because technology such as Zoom, I work from home 100%. There's no need to drive anymore to the office. So the owners of these office buildings, they're not making their payments because people are just they're canceling their leases. Companies are canceling the leases. So it's going to spell a huge disaster for especially regional banks. According to HeartNet, office occupancy rates are still less than 50%. As work from home trends persist, of course, they will not go down. I think the need to work from home, people are actually requesting from employers. The number one request is to work from home. People who are switching jobs and all that. So it's going strong, and it will continue to get stronger, I think. So there's nearly $450 billion in commercial real estate loans that are maturing in 2023, this year. And about 60% of them are held by banks. This is an absolute catastrophe. So imagine this is based on JP Morgan's most recent article. Imagine you're getting less income and you're refinancing at double the rates you did a couple or 3-4 years ago. You're making double payments and your income is cut in half. Like I said, this is going to be an absolute catastrophe this year, and it will hugely impact banks and the entire stock market. JP Morgan said we expect about 21% of commercial mortgage-backed securities outstanding to default. It would imply about $38 billion in losses for the banking sector. And this percent, they said, is greater than the financial crisis that we had in 2008. So losses in commercial real estate could be much worse than the 2008 Great Recession, based on JP Morgan, because the 2008 recession was actually driven by relatively short recession, While today's dynamics, this time around, basically the dynamics are being driven by work from home trends that show no signs of letting up and continued sticky inflation on higher rates for longer, basically. And you add the geopolitical risks I mentioned before, you get an absolute catastrophe. The next thing I want to talk about is the consumer credit card debt. It actually hit the end of last year, 2022, it hit a record high of $930 billion. That's almost $1 trillion in credit card debt. And conveniently, add the highest interest rate on record. So you can imagine the absolute disaster that's coming up soon. And of course, today's rates for credit cards are above 20%, I think, at least above 20%. Average credit card balances rose to $5,800, so pretty much $6,000. In 2023, serious credit card delinquencies, usually defined as being more than 30 to 90 days late, are expected to rise from 2.1% to 2.6%, almost 3%, which spells, of course, massive losses for credit card companies and banks and whatnot. Once layoffs starts happening, which every day you see news of huge companies laying off thousands of employees, what do you think is going to happen to this $1 trillion debt, credit card debt? And what do you think is going to happen to home mortgages? Do you think consumers, once they lose their jobs, they're going to continue paying? Of course not. So the rise of credit card defaults will rise. The rise of foreclosures will occur. So it's going to be basically like a domino effect. And it's going to be a very nasty recession. The next thing that's a pretty big risk is, of course, people have been talking about this, the CNBC has been talking about it, is an earnings recession, which is just very simple math. When rates go up and inflation is up, expenses are up. So there's no reason why companies will have higher earnings than last year.
So let's look at the last 10 recessions the US has experienced since 1950. My analysis looks at how the S&P 500 has performed during each US recession since the mid-1950s. So as you can see here, this is a chart of the real GDP over the past few decades with significant drops apparent during recessions. The second chart reveals earnings per share drop or rise, PE compression, as well as the S&P 500 actual index declines. On average, the S&P 500 earnings declined 16.4% in recessions. In 1973 through 1975 and the 1980s recessions, which is the closest to what we are experiencing right now, price to earnings fell 1.9% in the 1970s and 26.8% in 1980, averaging a drop of 44%. And the S&P 500 dropped 48% in the 1970s and 17% in 1980, averaging 32%. And as you will see in the next chart, the current PE is 21.64, which looks very high compared to historical numbers. In conclusion, the average price to earnings contraction was 26%, and the S&P 500 index average decrease was 31.5%. During recessionary periods, U.S. corporations always encounter sharp contraction in their profits, PE multiples, and of course, stock price. The last 10 recessions each had big drops in the S&P 500 price and PE multiple, while earnings declined in 8 of the 10 recessions. To date, the S&P 500 only dropped from a peak of 4,800 in 12/30/2021 to current levels of 4125. That's a 13% drop. It looks like we have a long way to go down based on historical contractions, especially with the big geopolitical risks we are experiencing today and the anticipated commodity supercycle, especially oil. Thank you so much for watching, and if you want to continue getting content like this, please subscribe, like, leave comments, and tickle the notification bell. Thank you so much.